ACCA AA, Audit and Assurance. So we are revising previous topic that we have covered. So let's move towards one good question. Chestnut. Chestnut. This is a scenario, and based on scenario, there will be 5 MCQs that we need to answer. So the following scenario relate to question 173 to 177. And it is 1st July 20x5. You are the audit manager of Chestnut and Company and are reviewing the key issues identified in the files of 2 audit clients. And there are some issues that have been identified. The first audit client is Palm Industries Company, Palm. A listed company. Palm's year end was 31st March 20x5. And the draft financial statements show revenue of 28.2 million, receivables 5.6 million, and profit 4.8 million. The field work stage for this audit has been completed, mean audit work almost completed. We are at the final stage. We are reviewing final things before signing the report. So client year end is 31st March 20x5, and client revenue, profit, and receivable figures are given. A customer of Palm owed an amount of 350,000 at the year end. In this receivable, there is one customer balance of 350,000. Testing of receivable in April highlighted that no amounts had been paid to Palm from this customer, as they were disputing the quality of certain goods received from Palm. Means this customer to whom the balance due is 350, till April they haven't paid any amount because the sale was disputed. Customer saying company send defaulted goods, wrong goods, damaged goods. So that's why we're not gonna make payment. The finance director is confident the issue will be resolved and no allowance for receivable was made with regard to this balance. So company haven't recorded the bad debts. Company haven't recorded the bad debts. And finance director saying, no, we're gonna resolve this issue, so don't need to adjust. But we saw the balance might not be recoverable. I mean, there are chances of bad debts of 350,000. And if company do not record this 350,000 bad debts, ultimately there will be misstatement. Are you with me? Currently, we are in July. Client year end is 31st December. And audit report has not been signed yet. If we see this 350,000 balance, whether it is a material or not, so 0.35 divided by profit of the company is a 4.8. So this is a 7.3% of profit and hence material. And per IAS 10, we can see this is post year and adjusting event. For IAS 10, this is what? Adjusting event, because we need to adjust this balance if company is still unable to recover even after the 2-3 months of the year end. That's it. The second audit client is Ash Trading Company. Ash is a new client of Chestnut Company. Its year end was 31st January 20x5. Okay, and we are in 1st July. And the firm was only appointed as auditor in February 20x5. This means at year end we were not available, as the previous auditor was suddenly unable to undertake the audit. In February, their previous auditor left the audit, so that's why we were appointed as auditor after the year end. The field work stage for this audit currently ongoing, and we are still performing audit procedure on this client. The inventory count at Ash warehouse was undertaken on 31st January 2025, but we were not available at that time, and was overseen by the company's internal audit department. And who observed the inventory count? Internal auditor. Neither Chestnut nor the previous auditor attended the count. Who is Chestnut? Our audit firm. So even the previous auditor, no external auditor was available during inventory count. Detailed inventory record were maintained, but it was not possible to undertake another full inventory count subsequent to the year end. Company cannot count again. So we learned this if we were not available at the year end, so we can perform inventory count when we are available, but that is not possible here. If inventory count we haven't attended at the year end, not possible to count inventory now, so there will be scope limitation, will not be able to verify inventory quantity. The draft financial statements show a profit before tax of 2.4 million, revenue 10.1 million, and inventory figure is 510,000. If we look at inventory 510,000 against profit of the company, that is 2.4. So this is 21.25% and highly material amount. But we are unable to verify inventory. This is the issue here. And in first company palm, there was issue of bad debts adjusting per IAS and adjusting event. Okay, this is the scenario available. Now look at the MCQs, what is required. Which of the following audit procedures should be performed in order to form a conclusion on whether an amendment is required in palm company, mean these bad debts should be adjusted or not? What procedure we will perform through which we will be able to identify whether there is chance of bad debts or not? So which of the following audit procedures should be performed in order to form a conclusion on whether an amendment is required in Palm 20x5 financial statements in respect of the disputed balance? We are going to check bad debts. Bad debts mean valuation of receivables. We are going to check valuation of receivables. Review whether any payment have been subsequently been made by this customer since the audit field work was completed. Yes, in post year end period, we will see whether there is any payment received from this customer or not. If received, no chance of recording bad debts. If not received, obviously there is chance of recording bad debts. So this procedure we need to perform. Is that? Match the total of the aged analysis listing to the sale ledger control account. No, this is not for valuation. This is for existence. Comparing reconciled receivable ledger balance with the control account. This will be studied under existence of receivable. So this is not for checking bad debts valuation. Vouch the balance owed by the customer. Vouch mean matching invoices. So vouch the balance owed by the customer at the year end to sale invoice, mean matching receivable ledger balance to sale invoice. This is for verification of occurrence, what other than valuation. So this is not performed because through this we'll be able to just identify whether this sale is genuine or not. Sale is genuine, but we need to see whether the balance company will be able to recover or not, because customer saying the goods were faulty, we're not gonna make payment. This means sale happened. So that's why C is not appropriate, because this is to verify whether sale happened or not. Are you with me? Review the latest customer correspondence with regard to an assessment of the likelihood of the customer making the payment. Yes, if there is any communication between company management and customer, so through that communication will be able to identify what is the chances of customer making the payments. So this we need to perform. Are you with me? So first and last we need to perform, but B and C we don't need to perform. Question 174. Which of the following correctly summarizes the effect of the issue relating to the inventory count of Ash at the year end? There is a scope limitation. So which of the following correctly summarize the effect? Is that the account balance is material or not. So we have identified this was what 21.25% of profit. So hence balance is material. This means either option C or D. Because A, B saying what? Balance is not material. No, balance is material. What do you see? Opening inventory may be material initiated. No, this is relating to closing inventory rather than opening inventory because through inventory count we verify closing inventory, current asset. Gross profit may be overstated. Yes, if a closing inventory is overstated, ultimately GP will also be overstated. So option D is the correct option. Is that? Because A, B, no. Why? Because balance is material. And this is relating to closing inventory rather than opening inventory. Question 175, please. Can you try by yourself? Then we will discuss. Be careful, it's a tricky one. So the audit engagement partner for ASH has requested that additional audit procedures be performed in order to conclude on the level of adjustment needed in relation to the above inventory issue. So we are going to check inventory through alternative procedures because inventory count, we couldn't attend it and now it is not possible. So which two of the following audit procedures should be performed in order to form a conclusion as to whether ASH 20x5 financial statements require amendment or not, mean whether inventory balance is accurate or not. Which two procedures we will perform alternatively? First one, obtain a copy of the aged inventory report and use computer assisted audit techniques to verify the accuracy of the report. Aged inventory report, we check age of inventory. Age of inventory means that is in the stock from longer period because that might be out of fashion, obsolete, damaged, out of season. That we perform for valuation. Here the issue is to check where inventory existence. So inventory age report mean the slow moving inventory to identify slow moving inventory because its value is NRV could be lower than cost. So that is for valuation rather than existence. Here the issue is regarding existence of the inventory. And discuss the valuation of slow moving. No, this is not appropriate procedures. B, review the internal auditor's report who were there at inventory count. So review the internal auditor report on the inventory count to identify the level of adjustment made to the record. In order to assess the reasonableness of relying on the inventory record for the purpose of year-end audit, yes, we can review internal audit report when he attended the inventory count. He ensured whether after count inventory was adjusted, what was the difference. So we can review his report. We can rely on his report. Perform test count of inventory in the warehouse to compare these first to the inventory record. This is called floor to sheet. Is that? And then from inventory record to warehouse mean sheet to floor. Yes, through this we can verify existence and completeness of inventory. In order to assess the reasonableness of the inventory record maintained by Ash, yes, this we can perform. The last one, review Ash's sale order book for February, March, and April to estimate the level of inventory that will need to be produced in the new accounting period to fulfill customer demand. No, this is not for inventory existence. This is for future demand, to identify future demand. So this will not be appropriate procedure because there is issue of inventory existence that we need to verify because we couldn't attend the inventory count because we were not there at that time. And now the inventory count is not possible to perform. This is the main issue. Are you with me? 176, please. Can you try by yourself? Following the inability to attend the inventory count of Ash, an engagement quality reviewer has been appointed to the audit. Indicate which of the following should be included within engagement quality control review. What he will check regarding quality of the audit because we couldn't attend the inventory count. Evaluation of all significant audit judgment. Yes, he will evaluate all the audit significant judgment that we made regarding the inventory. Yes, this will be included. Evaluation of the performance of specific audit procedures performed. In what procedures we performed, ultimately quality control reviewer will check whether we have performed procedures appropriately or not. Evaluation of the cost effectiveness of the audit process. Regarding inventory cost effectiveness, he is checking. He will check cost effectiveness from overall audit point of view, not relating to this inventory issue only. So this is not relating to inventory issue. He will perform, but not relating to this particular issue of inventory. Evaluation of conclusion reached in formulating auditor report. Yes, what conclusion we reach regarding the inventory, whether inventory balance is material emissated or not material emissated, this will be included. Are you with me? 177. Five, please. This is relating to audit report. So alternative procedures performed as a result of Chestnut Company being unable to attend inventory count of ash did not provide sufficient appropriate audit evidence regarding the inventory balance in the statement of financial position. Mean we don't have sufficient appropriate audit evidence related to inventory, mean there is a scope limitation, inability to obtain sufficient appropriate audit evidence. From the option below, indicate the audit opinion which would be given in these circumstances and the appropriate disclosure in the audit report. So ultimately, we will issue qualified opinion. Qualified opinion. And the reason we will explain where under basis for opinion paragraph, basis for qualified opinion paragraph. Option A, yes, qualified opinion and reason we will explain in basis for qualified opinion. Why not B? Because disclaimer is not required because the matter is material rather than pervasive. Why not option C? Qualified opinion, that's fine. But key audit matter section, no. Reason we need to explain in basis for opinion paragraph rather than key audit matter. And D, disclaimer is not appropriate because the matter is material rather than pervasive. Are you with me? This was a good question. Before moving towards question, let's discuss one last topic we left. That is written representation from management. During audit, obviously, per ISA 500, auditors shall obtain sufficient appropriate audit evidence before expressing the opinion. We need to obtain evidence before expressing the opinion, and those evidence must be sufficient and appropriate. And audit evidence sufficient mean audit evidence must be quantity. In quantity mean must be enough. But there are some account balance against which we are unable to take sufficient mean enough evidence. So what we do to make the audit evidence sufficient, we ask company management, please write on this page, this balance is accurate, and that page is called written presentation that we take as a extra evidence to make the audit evidence sufficient. So that we must be having enough evidence. If management have written any account balance in the financial statement, ultimately they will write on a page and will give us as evidence, yes, this account balance is accurate. Is that? So for some account balance, if we are unable to obtain sufficient evidence, so to make audit evidence sufficient, we request written representation from management. Written representation from management. Who is providing this? Company management providing this to the auditor. What? Written representation as a extra evidence where auditor do not have sufficient evidence. But on its own, written representation is not sufficient evidence. We should always obtain corroborative evidence. We should always obtain corroborative evidence. Corroborative. Corroborative evidence means extra supporting evidence. Corroborative evidence means extra supporting evidence. On its own, written representation is not sufficient evidence. We should always obtain corroborative mean extra supporting evidence. If we are having written representation and we are having extra supporting evidence that we have obtained through performing our audit procedures from client records, if we are having both, this means we are having sufficient evidence based on which we'll be able to express any opinion. If we are having only written representation, there is no other evidence we able to obtain. So on its own, written representation is not sufficient evidence. So there is a scope limitation. Due to that, we will qualify the report. If we are having other supporting evidence, but those supporting evidence are not enough, so we ask the management to provide written presentation, but management refused to provide written presentation. So whether we are having enough evidence? No. So there is a scope limitation, and due to scope limitation, we will qualify the audit report. If we are having both, this means we are having sufficient. Now we'll be able to express opinion. If we are having only written presentation, no other supporting evidence, so on its own representation is not sufficient. Scope limitation. We are having other evidence and they are not enough. That's why we asked the management to provide written presentation. They refuse to provide. Scope limitation. If we are having both written presentation and supporting evidence, but both do not same, both contradict with each other. In written presentation saying something different, or evidence, supporting evidence saying something different. Who is right? Can we decide? No, because individually both are not sufficient on which we can decide. If both are contradicting with each other, this means there is a scope limitation. Qualified report due to scope limitation. Scope limitation, we don't have evidence, enough evidence to express the opinion. Are you with me? So during audit, regarding some account balances, if we are unable to obtain sufficient evidence. So to make the audit evidence sufficient, we require evidence from company management to make the audit evidence sufficient, and that evidence from management is called written representation from management. But on its own, written presentation is not sufficient evidence, because if management have a stated account balance in the financial statement, they will write down on the page, there is no issue. So that's why we should always obtain corroborative extra supporting mean on evidence, further evidence as well, additional evidence as well. If we are having only written presentation, no other evidence, scope limitation. If we are having other evidence, but that are not sufficient and management refuse to provide written presentation, there is a scope limitation. If we are having both written presentation and other evidence, and if both same, yes, we are having sufficient evidence to express the opinion. But if we are having both, but both contradicting with each other, there is a scope limitation. Are you with me? Who is providing this written presentation to whom? Company management providing this written presentation to the auditor. But interestingly, its wording will be written by the auditor. Who will write the wording? Auditor will write the wording and ask the management to sign it. If we are asking the management to sign this wording, they might refuse. Why might be they are not happy with the wording? So if they refuse, we'll try to convince them through alternative wording. So if management refused to provide written presentation, so we'll try management to convince them through alternative wording. Might be this wording they don't like. If still they are not signing, we'll discuss with management importance. These are important. If you don't provide, ultimately you will not be having sufficient evidence to express the opinion. We will go for qualified report. But still, if they are not signing, in that case, there is a scope limitation. So due to scope limitation, we should move towards qualified report. Or in certain extreme circumstances, we should consider withdraw from the engagement, mean resign, mean despite changing the wording. If still management is not providing, this means there could be issue in other areas as well. We lost confidence on management integrity. And if we lost confidence on management integrity, in that case, we should not associate our audit report with the wrong people. We should consider withdraw from the engagement. Are you with me? Okay, so during audit, if we are unable to obtain sufficient evidence regarding any account balance, we'll take extra evidence from company management, that is called written presentation. So whether we require written presentation for every type of account balance? No. We require written presentation for two type of account balance. One is called matters known only to management. And second, matters involving judgment or estimate in measurement. So we require representation relating to matters known only to management and matters involving judgment, estimate in measurement. There are some figures in the financial statements whose amount is based on company management estimate and judgment. What are those figures? Depreciation based on useful life of the asset. Who determine useful life of the asset? Company management is based on estimate. If we are unable to verify depreciation useful life properly, then we will ask management to provide written presentation. Mean sign this page. The useful life, your estimate of useful life is appropriate. If company have recorded a provision for warranty claim, so how much amount company should record as a provision? That is based on company management estimate judgment. So if we are unable to verify this provision amount properly, we will ask the company management to sign this page. The estimate used in calculating provision is appropriate, and we will take this written presentation as a extra evidence. So we obtain written presentation related to matters involving estimate judgment in measurement. Whose judgment estimate is involved? Company management. What are those? Depreciation and provision. There are some areas in the financial statements whose are in the knowledge of company management only if we were not there at the time of year. So might be we are not aware about that. So what we do at the end of every audit, we obtain some compulsory written presentation from company management regarding matters known only to management. What are those matters? We obtain a compulsory written presentation from management regarding NOCLAR. NOCLAR stands for non-compliance with law and regulations. We ask company management, please sign this page to say if there was any non-compliance with the law regulation that has been disclosed to the auditor and have been reflected into the financial statement. Because this is a matter known only to management, we might not be aware about it. We ask company management at the end of every audit to provide a written presentation regarding to fraud. Mean sign this page if any fraud happened during the year that has been disclosed in the financial statements and has been disclosed to the auditor. We require written presentation from management regarding post balance sheet adjusting and non-adjusting event. Post year end adjusting and non-adjusting event mean we ask company management at the end of every year audit, please sign this page if there was any post year end adjusting event that has been adjusted to the financial statement and any non-adjusting events has been disclosed to the financial statement. Because these are what matters known only to management. We require a compulsory written presentation regarding the disclosure of related parties. Mean we ask company management, please assign this page. All related party transactions have been disclosed to the auditor and in the financial statements because these are what matters known only to management. So we require representation regarding two types of matters. One, matter known only to management. What are those? Non-compliance with law regulation has been disclosed to the auditor and in the financial statement. Fraud happened during the year have been disclosed to the auditor and it is in the financial statement. Post year end adjusting events have been adjusted and non-adjusting events have been disclosed. And related party transactions have been disclosed to the auditor and in the financial statement. And we require written presentation regarding the matter involving judgment estimate in their measurement if we are unable to obtain sufficient evidence regarding these matters. What are those matters? Depreciation, provisions. Are you with me? So during audit, if we are unable to obtain sufficient evidence regarding any account balance, we ask the company management to provide additional evidence called written presentation from management. Who is providing this? Company management to auditor, but interestingly, who designed the wording? Auditor. And we require written presentation relating to two matters, matters involving judgment estimate in their measurement and matters known only to management. For these matters, if we obtain sufficient evidence, there is no need for written presentation. Regarding depreciation useful life, if we obtain information from any of the expert regarding useful life, there is no need for written presentation. Regarding premium, if we verify, okay, the amount of a premium was that and the company received these exactly claimed during the year, there is no need for written presentation. Regarding any litigation, if company have recorded premium and we got information from lawyer, external lawyer regarding probability, possibility, there is no need for written presentation. But matters known only to management, these are the matters against which we need to obtain compulsory written presentation at the end of every audit. Before signing the audit report, we need to obtain these representation from company management regarding non-compliance with law regulation, regarding the fraud, regarding post-year and adjusting non-adjusting events, and regarding disclosure of related parties. What are the other compulsory written presentation that we obtain at the end of every audit? That is also management responsibility. What are the management responsibility? Financial statements preparation is the management responsibility according to standard. Implementing internal control system is the management responsibility. Providing all information relating to audit to the auditor and access to record is the management responsibility. And all transactions have been recorded in the financial statement. This is the management responsibility. And for this, we obtain representation from company management at the end of every audit. This is what matters known only to management. We obtain compulsory representation from company management regarding the reasonableness of accounting estimate and judgment. If any figure is based on estimate judgment, so those estimate are reasonable. We obtained compulsory representation regarding the disclosure of related party transaction to the auditor and in the financial statement. Regarding subsequent event, we obtain compulsory representation like all adjusting events have been adjusted and non-adjusting events have been disclosed. We obtain written presentation from management at the end of every audit that if there is any misstatement in the financial statements uncorrected, so this is that is not material, that is what immaterial. In uncorrected misstatement in financial statements are immaterial. Relating to fraud, we obtain written presentation like all fraud happened during the year have been disclosed to the auditor and disclosed in the financial statement. Non-compliance with law regulation, non-compliance with law regulation have been disclosed to the auditor and in the financial statement. And regarding litigation, if there is any litigation against the company, that have been disclosed to the auditor and in the financial statements in terms of either provision or contingent liability. So these are the area against which we require a compulsory mandatory written presentation at the end of every audit. Before obtaining these written presentation, we do not sign the audit report. Regarding management responsibility, reasonableness of estimate, related party transactions, subsequent event adjusting, non-adjusting, uncorrected misstatements are immaterial. Regarding disclosure of fraud, disclosure of NOCLAR, and disclosure of litigations. Are you with me? If doubts as to the reliability, if we are realizing the management written presentation is doubtful, mean inconsistent with other evidence, we should discuss with management to resolve the matter. We should revise our risk assessment because our procedure is showing something different. Management is saying something different. This means there is issue. And we should consider the other representation that we have made might be that are also different. We should reevaluate the integrity of management, mean whether they are fraudulent people or honest people. And if we have a serious concern about management integrity, then we should consider withdraw from engagement. From engagement, these are two separate words. If management refuse to provide representation, we need to discuss matter with management, try to convince them through alternative wording. If still they are not providing, there is a scope limitation, and due to scope limitation, if the matter is material, we will express qualified opinion. If the matter is pervasive, we will express disclaimer opinion. And if there is any doubt on management integrity, instead of expressing opinion, we will consider withdraw from the engagement. Are you with me? Now regarding syllabus, we have covered each and everything. Now we need to practice question. So let's move toward one more good question. That is Humphries. So we are having this question, Humphries. Let's discuss that. It is 1st July 20x5. Humphries Company audit client operate a chain of food wholesalers across the country, and its year end was 30th April 20x5. Always underline the year end, that is 30th April 20x5. This means this year was started on 1st March 20x4. The final audit is nearly complete, and it is proposed that the financial statements and auditor's report will be signed on 13th July. Currently, you are on 1st July, and our report is not signed yet. You're going to sign on 13th July. Revenue for the year 78 million. Mean client company financial statements revenue is 78 million, profit 7.5 million. Why? To check materiality of any issue. The following information come to light. Can you reading these three separate paragraphs? This is a separate. This is a separate. And this all together separate. Can you identify whether this, and this, which one is a adjusting event, which one is a non-adjusting event? By applying IAS 10 knowledge. Please try to identify which one is adjusting event out of these three and which one is non-adjusting event. You need to identify out of these three, which one is adjusting event, which one is a non-adjusting event for IAS 10. If we look at the first issue, Humphries Company has three warehouses following extensive rain on 20th June. Rain and river water flooded the warehouse located in Bass. So year end was 30th April. So 20th June, after year end, some warehouse damaged due to extensive rain. All of the inventory in the warehouse was damaged and has been disposed of. Mean after 50 days of the year end. Inventory disposed of, damaged due to rain. The insurance company has been contacted. So no amendments or disclosure have been made in the financial statements. This is the adjusting event or non-adjusting event. So per IAS 10, this is what? Non-adjusting event, because condition do not exist at the year end. This is not event from before year. This is after 50 days of the year end. So need a disclosure in the financial statement. Because current financial statements has not been signed. Because our report is not signed. Are you with me? A customer of Humphries Company has been experiencing a cash flow problem, and its year-end balance is 0.3 million. Mean there is a receivable recorded in the financial statement of 0.3 million, and that receivable mean customer is experiencing cash flow problem. If we just check materiality of this receivable, 0.3 million against 7.5 million profit. So 0.3 million against 7.5 million profit. So that is just 4% of profit and not material. Can you check whether it is 1% or more of revenue? If we check against revenue, that is a 0.3 against 78. So that is what? 0.38%, so not material. Okay. The company has just become aware that its customer is experiencing significant going concern difficulty, but experience is facing going concern issue. The management of Humphries Company believe that as the company has been trading for many years, they will receive some. But management is saying we can recover some amount, if not full. So payment from the customer, hence they have not adjusted the receivable balance. If you gonna receive some for remaining, you need to adjust. Whether it is adjusting or non-adjusting event. So per IAS 10, this is adjusting event. Adjustment is required. But the amount is immaterial. If management do not adjust, even there will be no issue on the audit report. But for IAS 10, this is adjusting events. Currently, we are identifying whether adjusting or not adjusting. Are you with me? And the third issue, a key supplier of Humphries Company is suing them for breach of contract. So supplier have filed a case against the company for breach of contract. The lawsuit was filed prior to the year end. Filed prior to the year end, means this case was filed before year end. And the sum claimed by them is $1 million and 1 million against profit. It is material. And this has been disclosed as a contingent liability in the notes to the financial statements, and company have disclosed as contingent liability. But if it is meeting a criteria of provision like probability of future economic outflow, then there must be provision rather than contingent liability. Correspondence has just arrived from the supplier. I mean, after year end, there was some communication with the supplier indicating that they are willing to settle the case for payment by Humphries Company of 0.6 million, and they are managing payment with 0.6 million, not 1 million. 0.6 million against 7.5% million is 8% of profit and hence material. And it is likely that company will agree to this, mean company will pay the money, likely mean there is a probability. So for IAS 10, this is what adjusting event, because for IAS 37, it is meeting a condition of provision. So financial statements need to be adjusted, mean company need to record provision rather than disclosing as contingent liability. So first issue is what non-adjusting event need disclosure in the financial statement. That is relating to inventory destroyed due to fire, due to flood. Second issue is relating to bad debts, that is adjusting, but the amount is immaterial. And third issue regarding provision, this is adjusting event. So this is the scenario we are having. Now we are moving towards dealing with MCQs. 78, can you try please? 78, what could be the option? Either this. So which of the following audit procedures would identify subsequent events occurring up to the date of audit report? In which one is relating to identifying subsequent event? Inquire of management whether there have been any unusual accounting adjustment. Yes, this is relating to subsequent event. We will ask management if there is any adjusting event. Inquire of management whether there have been any issue of shares, debentures, or change in business structure. Yes, we will ask this management, because regarding this, there should be adjustment in the financial statement. Review management procedures for identifying subsequent event to ensure that such events are identified. Mean management is identifying post-balance sheet adjusting and non-adjusting events properly or not. Yes, we will review management procedure. This is related to subsequent event. Obtain representation that all subsequent event requiring adjustment are disclosure. Yes, this representation we need to require from management at the end of every audit relating to subsequent event. So this is also true. So all are true. Is that? Now try this 179, please. Yes. Which two of the following statement correctly describe the likely impact that the flooding of a warehouse will have on Humphries' financial statements for the year ended 30th April 20x5? That is, that was what? Non-adjusting event for IAS 10. So inventory should be written down because the flood damage is an adjusting event. No, this is wrong. Inventory should not be written down because the damage is not an adjusting event. Yes, they need to be disclosed. If material amount of inventory is uninsured, mean company have to bear the loss. It may be necessary to disclose the event and an estimate of the financial loss. Yes, disclosure is required. If insurance proceeds are more likely than not to be received, this is very important, not to be received. A contingent asset should be recognized. No, contingent asset should be recognized when there is a probability of economic inflow. And here saying not to be received. No, is it to be received, likely to be received, then contingent asset should be there. So this is also wrong. Are you with me? Try this 180, please. There are three issues. One relating to warehouse inventory damage non-adjusting. Other relating to bad debts of receivable adjusting, but the amount is immaterial. And third relating to provision. Company have recorded contingent liability, but there are chances of provision adjusting event. Try this 180, please. So which two of the following audit procedures should be performed in order to form a conclusion on the amendment required to Humphries Company 20x5 financial statements in respect of 0.3 million owed by customer experiencing financial difficulties? So which two of the audit procedure will perform to conclude that receivable balance is overstated? We are going to check overvaluation of receivable. We are going to check overvaluation because bad debts not adjusted. Review the post year end period for payment received from customer in respect of. Yes, in post year end cash receipts, we will see whether company have received cash. Yes, this was not bad debts. If not received, this is bad debts. But two, review correspondence with the customer to assess the likelihood of Humphries companies recovering. Yes, a communication with the customer will be able to review if there is any. That will be properly providing evidence whether customer is in a position, in a mood of making payment or not. So this will also be the procedure. Writing to the customer to request confirmation of the amount owed to Humphries company at the year end. No, this is a for rights and obligation rather than valuation. We are going to check valuation. Circularization, confirming balance from the customer. That is what relating to rights and obligation ownership. Ask management to provide a revised cash flow forecast covering at least 12 months after the year end. There is no issue of going concern. Why we are asking cash flow forecast from management? This is not relating to receivable bad debts. Are you with me? So A and B, try this 181, please. So complete the following sentence regarding the auditor's report by seeing from option provided. The lawsuit where provision is required relating to a breach of contract is considered to be what material? Immaterial. This is material. Is that? Because we saw 0.6 million against profit. In this 0.6 million against profit, that is 8% of profit, and hence that balance is material. Okay. What else? And therefore, if the financial statements are not revised, mean they haven't recorded provision in the light of new information, then audit opinion will be qualified due to material misstatement. Are you with me? If they do not adjust the financial statements, means still they want to show it as contingent liability rather than recording as provision. Moving towards 182. Try this, please. It is now 13 July 2025. The audit report has been signed. This means we have moved towards a period 2 according to ISA 560 year end to audit report assigned, and now before issue. So this was period 1, this was period 2, and this is what period 3, subsequent event ISA 560. So it is now 13 July. The audit report has been signed. And currently we are here. In previous, we were here. So the financial statements are due to be issued on 25th July. I mean, not issued yet. Which of the following statement correctly describe the auditor's responsibility in relation to subsequent event occurring between now and 25 July? Mean auditor is active here, but here auditor is passive. So what is auditor responsibility relating to subsequent event that we need to discuss? The auditor must design procedures to obtain sufficient appropriate audit evidence that all events up to the date that may require adjustment or disclosure have been identified. No, this procedure auditor need to perform before signing the audit report, mean during final audit, not after signing the audit report. The auditor must perform procedures on matter examining during the audit which may be susceptible to change after the year end. No, this is not auditor. Do not perform any procedures here after signing the audit report. The auditor has no obligation to perform procedure, yes, or make inquiries regarding the financial statement. Any subsequent event should be noted and considered in the next period audit. No. If there is any subsequent event noted here relating to the financial statements that we have reported on, we should request management to amend the financial statement. If the auditor becomes aware of a fact that had it been known to the auditor at the date of the audit report, may have caused the auditor to amend the auditor's report, the auditor shall discuss the need for any adjustment with management, meaning if auditor is aware about any matters here that must have been identified here regarding any financial statements regarding audit report. So yes, auditor need to ask management to amend the financial statements. So this is appropriate regarding period 2. This will be appropriate response regarding period 2. Are with me? So let's move towards one more question, then we will take a break. So we are having this question greenfield. And based on this question, we'll be having 5 MCQs again, 183 to 187. And it is the 1st July 20x5. Greenfield company specializes in manufacturing equipment which can help to reduce toxic emission in the production of chemicals. I mean, they manufacture some equipment for chemical industry. The company has grown rapidly over the past 8 years, and this is due partially to the warranties that the company gives to its customer, because company provide warranty on their product. This means there should be warranty premium in the financial statements as well. It guarantees its products for 5 years, and if a problem arises in this period, it undertakes to fix them or to provide a replacement product. I mean, either they repair that product or provide replacement product. That is warranty they provided. This means there must be warranty period in the financial statement, because based on this warranty providing, company have grown rapidly. You are the manager responsible for the audit of Greenfield company, and you are performing the final review stage of the audit and have come across the following issues. And there are 3 different issues: receivable balance, warranty provision, and other information. Receivable balance. Receivable balance. Greenfield company has a material receivable balance. So receivable balance is material from financial statement point of view. Owning from customer Yellow Mix company. Customer name is Yellow Mix. Our client is Greenfield. During the year-end audit, your team reviewed the aging of this balance and found that no payments have been received from Yellow Mix company for over 6 months. mean received balance from a customer is overdue from last 6 months. Company haven't received any amount. So might become bad, but company haven't adjusted. And greenfield company would not allow this balance to be circularized, and client is not allowing us to confirm balance from the customer. Okay. Instead, management has assured your team that they will provide a written representation confirming that the balance is recoverable. No, written representation on its own is not sufficient evidence. We need corroborative evidence. And corroborative evidence, ultimately, we need to confirm, we need to check correspondence, we need to check cash receipt in post year end period. And through cash receipt, we identified no payment received in last 6 months. Is that? So this means this receivables is what overstated, bad debts not adjusted. I will mean. Second issue is the warranty provision. The warranty provision included within statement of financial position is material. Obviously, company providing warranty, so they have recorded warranty provision that is material from financial statement point of view. The audit team has performed testing over the calculation and assumptions which are consistent with the prior year. So we check in previous year company record the same warranty company have recorded in this year mean the amount is okay. The team has requested a written representation from management confirming that the basis and amount of the premium are reasonable. Management has yet to confirm acceptance of this representation, and management haven't provided written representation till now. Might be they will provide in later date, but till now they haven't provided written representation. But we have verified through alternative procedures, mean we are having corroborative evidence that balance is okay. But to make audit evidence sufficient, we need written representation from management that we haven't received yet. So regarding receivables, there is chance of bad debts not adjusted. Regarding warranty premium, everything is okay, but we need extra evidence. We don't have sufficient evidence, and management yet to confirm providing written representation whether they provide or not. Other information. Other information. What was other information? Other information in the annual report. Chairman, CEO statement, actor statement, that is other information. You have reviewed a financial summary which is to be included in the annual report and have found that the details are inconsistent with the financial statement, meaning other information is inconsistent with the financial statement. Your investigations have shown that the error is in the summary and not the financial statements, and other information is wrong. Financial statements are accurate. This means we need to highlight through other information paragraph in the audit report. There is a material misstatement in other information, not other matter, because this is not the example of other matter. This is a other information paragraph. So there are three issues. One, receivable bad debts not adjusted. Second, for warranty premium, we do not have sufficient evidence and management haven't provided representation yet. And third, other information is inconsistent. Try this MCQ 183, please. Okay. Assuming you received the written representation as described above for both the receivable balance and warranty premium, for both you have received written representation and receivable, we know there is issue, but for warranty premium, everything is okay. Just to make audit evidence, we need written representation that we have received. In respect of which balance is the auditor most likely to conclude that sufficient appropriate evidence has been obtained? Regarding receivable, management do not allow for circularization. Without circularization or other procedures, written representation is not sufficient. But for provision, only written representation we need. So we conclude that sufficient appropriate evidence has been obtained for warranty provision only. Is that not for receivable? Because warranty premium we have checked with the previous year, the amount is similar, but only representation we need to receive. But for receivable, management is willing to provide, but they are not allowing us to perform circularization. Other evidence are not available. I 184, please. There is issue of valuation of receivable, please. So which two of the following audit procedures could be audit team carry out to obtain independent evidence relating to the recoverability of the debt from yellow mix company? First one is saying review correspondence with yellow mix company regarding the late payment. Yes, correspondence, so that we will be able to identify whether there are any chances of receiving. Trace a sample of good dispatch note to yellow mix company sale invoices. No, this is for completeness rather than valuation. Forward matching GDN to invoice. Trace the entries in yellow mix company accounts in the receivable ledger to invoice. Backward matching from ledger to invoice. So that is for occurrence. Perform a review of post year and cash receipts to ensure cash has been received or not. Yes, this is relating to valuation. So the issue is valuation. Bad debts not adjusted. Sale occurred. Completely recorded. Are you with me? Try this 185, please. So management has now stated that it is not prepared to confirm that the basis and amount of the warranty premium are reasonable. That it is not prepared to confirm means they are not providing you written representation. Okay. Indicate which of the following action you must perform in accordance with ISA 580 written representation if they refuse to provide written representation. Discuss with management why they have refused to provide written representation. Yes, this we need to perform. Reassess the integrity of management and consider the implication for any other representation. Yes, we need to reassess their integrity. Whether the other representation, if they have provided, whether they were genuine or not. Seek legal advice. We need to consult the lawyer. No, we don't need to consult the lawyer. Resign as auditor. No, first we need to see because the amount we have verified with the previous year, only we don't have sufficient evidence. We don't have sufficient evidence. We need to try for other evidence if we can obtain. If they are not providing representation, we need to wait for their reply why they are not providing. So no need for resign here. It's not that much serious issue. Not with me. 186, please try. So you have discussed the matter with management, but they are still not prepared to provide the representation that you have requested for that warranty premium. This means we don't have sufficient evidence regarding warranty premium. Inability to obtain sufficient evidence. Matter is material, not pervasive. So what type of modified opinion would be issued and what would be the basis for that modification? So qualified opinion due to inability to obtain sufficient appropriate audit evidence. Which one? D. Not A, because there is no material misstatement issue. Not B, because this is material rather than pervasive misstatement. Not C, because there is a scope limitation rather than material misstatement. Are you with me? We try this 187. Yes. So you have notified that directors of the error in the summary financial statement. Mean other information was inconsistent. Which of the following correctly summarize the impact on the auditor's report if directors do not correct this error? So audit opinion should be what? Unqualified, unmodified, but we need to highlight that matter through other information paragraph. The option A is saying a modified audit opinion and other information stating that there is nothing to report. No, both are wrong. This is also wrong. This is also wrong. Modified opinion, no, this is wrong. Other information section would not be required as there is nothing to report. This is also wrong. Unmodified opinion, yes. Other information section include a description of the uncorrected misstatements. Yes, other information is what wrong, uncorrected. Why D unmodified opinion? Yes. Other matter paragraph? No, 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 no. Other information paragraph is required. So which one is correct? Option C. Are you with me? Audit report concept he has tested. So let's take a break. After break, we will discuss some more similar good questions. Okay. ACCA, we are practicing questions from the kit. So we're having this question, strawberry. Strawberry. So the following scenario relate to the questions 188 to 192. Okay. You are the audit manager of Kiwi and Company. Your client is a Strawbery kitchen design company, Strawbery, which is a kitchen manufacturer. The company's year end is 30th April 20x2. Year end is 30th April 20x2. This means this was starting on 1st May 20x1. Strawbery has had a challenging year. Grape Company, a major customer of Strawbery, which owes $0.6 million, is experiencing financial difficulties. Okay, one of the customer of company who is having a balance of 0.6 million is facing financial difficulties. Mean company will not be able to recover money from this customer. However, the balance is included within the financial statement, mean included in the receivables. The sale director has recently left Strawbery and has yet to be replaced, and company do not have a sales director. This means if sales director is not there, nobody will be able to manage a sale. And if a business is not generating enough sale, ultimately there will be cash flow issues. As a result, Strawbery has struggled to win any new business in the last 6 months. In last 6 months, they haven't acquired any significant customer. Okay. The monthly cash flow has shown a net cash outflow for the last 2 months of the financial year and is forecast as negative for the forthcoming financial year. In company is having a negative cash flow low forecast, mean cash balance is negative in forecast. So this is an indication of going concern issue. Company haven't attracted new customer in last 6 months. Forecast cash balance is negative. Company is struggling to recover money from the customer as well. This will be the loss as well. And you have performed some analytical procedures on the draft financial statements and have calculated the following ratios. As compared to 20x1, 20x2, there are some ratios. Inventory holding period have decreased, but a little bit, 2 days having no impact. But still your inventory is stuck for 95 days, mean more than 3 months. Your cash is stuck with the inventory. Why? Because there might be no demand for your inventory in the market. Receivable collection period have increased, mean companies are struggling to receive money from customer, mean your cash is stuck with the customer. This is also poor cash flow. Payable periods have increased, though you have gained something from supplier, but your payable period is 4 months. 120 days mean 4 months. And if you do not pay to the supplier, ultimately they will stop providing goods on credit basis. They will call for cash basis. And if you don't have cash, even in your next 2 months cash flow, there is negative cash flow. So company will be in trouble. This is showing poor cash flow. Due to its poor cash flow, they have stated, Strawbery missed a loan repayment. Oh my God, you haven't paid the loan on time. And there is a breach of condition relating to loan. So bank can call anytime. And as a result of this breach in the loan covenants condition, the bank has asked that the loan of $4.8 million be paid in full within 6 months. You have to pay within 6 months, and your next 2 months cash flow showing a negative cash balance. Even there is no hope for future because you are struggling to receive money from customer. You are paying later and later to the supplier. And in last 6 months, if you haven't acquired any business and you don't have even sales director who can help you to recover new customer, but there is no hope. So company is facing cash flow going some issue. Is that question 188? Try please. So which of the following are potential indicators that Strawbery is not a going concern? The breach of the loan covenants, yes, this is the potential indicator because bank, that's why calling back loan, you need to pay within 6 months because you missed the payment. The departure of the sale director, yes, there is no sale director, so there will be no chance of getting a new customer for recovery. The fall in the inventory holding period, that is not that much fall. Even fall will result into recovery of cash, not the cash flow issue. This is not the significant cash flow issue. The negative cash flow figures, yes, that is also the option 1, 2, and 4. Is that? Try this 189, please. So you are reviewing the management assessment of Strawberry's ability to continue as a going concern. What period must management assessment cover? At least 12 months from the year end. So what period must management assertion cover? 12, at least 12 months from the date of the audit report? No, from the year end. At least 12 months from the date of the financial statements? Yes. A maximum of 12 months from the date of the auditor's report? No, maximum at least 12 months. A maximum of 12 months from the date? No, not maximum, at least 12 months. Try 190, please. So you are concerned that the debt due from grape company may not be recovered, well, and believe that this would have a significant effect on the viability of Strawberry. I mean, 0.6 million, that company was struggling to recover from the customer. So this will be having a significant effect on the company ability to continue as a going concern. Which of the following would provide you with the most reliable evidence regarding the recoverability of this debt? Mean through what procedure you will be able to verify whether this debt is recoverable or not? The most reliable audit procedure. A management representation confirming the recoverability, obviously they will say we're gonna recover. So this is not most reliable because this is internal. The response from customer to your circularization performed earlier in the audit confirmation the amount of, so that will confirm the balance rather than the recoverability. That will confirm the balance rather than the recoverability. Identification during your subsequent event review of a cash receipt for the full amount. Yes, if cash has been received, this means no chances of bad debts, accurate. If cash haven't received, ultimately this need to be registered as a bad debts. Correspondence between Strawbery's lawyer and grape company lawyer confirming the amount will be paid. No, there is no need for lawyer involvement. Yes, correspondence with the customer we can see, but with the lawyers, no. So option C is the correct option. Are you with me? Try this 191, please. So you have raised your concern with management regarding the ability of Strawbery to repay the 0.6 million loan in 6 months. I mean, bank have asked the company to pay the loan within 6 months. That they missed. The directors have assured you that this will be possible as they have a contingency plan. I mean, we can pay easily, no issue. Directors are saying. Which of the following course of action by the directors would provide you with the most assurance that Strawberry will be able to meet this commitment? I mean, from these four, what point give a more strong indication that company will be able to pay? Number one, plans to dispose of a property valued at 5.2 million in August 20x2 mean they will be able to sell inventory in August 20x2. 5.2 million plan whether they will be able to sell, because if they will sell property, what they will do, where they will perform the business. So this is not the most appropriate. The reopening of negotiation regarding the term of the loan with the current provider, they will renegotiation the loan with the bank. Might be bank will not agree because previous payment you haven't made, and might be they are aware about your cash situation, so there will be lesser chances they will renew. Plans to substantially cut production cost by moving production to Asia. It's not easy process. If you want to move your production to Asia, ultimately you need some investment to make over there. How you can move your production to Asia without having enough cash? Because ultimately moving overseas need cash. Here, if you are closing your production, ultimately you need to pay some of the obligations like redundancy cost you need to make. And the fourth one, agreement by an alternative financial institution to lend Strawbery 4.8 million in September 2022. Yes, if they are having agreement with other financial institution, mean bank, that they will provide a loan and they can repay back to the previous bank. So yes, this agreement external evidence will be most authenticate evidence. Are you with me? Why this 192, please? The tricky one, and I need correct answer, please. So you have concluded that Strawbery is not a going concern. So we have evidence, we have concluded that company is not going concern. This means financial statement should be prepared on breakup basis. Is that? If the directors refuse to amend the financial statements, mean they have prepared on going concern basis, mean they haven't prepared on breakup basis. Which of the following correctly describe the impact on the auditor report? So if they haven't prepared on breakup basis, ultimately the whole financial statements are wrong. There is pervasive misstatement. So opinion should be what? Adverse opinion. This means either this or this will be okay. Is that? Because company is not going as a not the issue of cash flow, there is going as an issue. So adverse opinion. And we will provide explanation where in basis of our adverse opinion. Not material uncertainty, because this is required where company have disclosed cash flow issue. To highlight that cash flow issue, we use material uncertainty relating to going some paragraph. If financial statements not prepared on breakup basis, so that is pervasive nature. So we'll provide adverse opinion and we'll explain the reason where in basis of our adverse opinion paragraph. Are you with me? Material uncertainty paragraph is not required. Material uncertainty paragraph we provide where company have provided a cash flow issue disclosure appropriately. So unqualified opinion, to highlight that cash flow issue, we use material uncertainty relating to going some paragraph rather than in phases of matter. If cash flow disclosure was required but company haven't provided, in that case, qualified opinion. Are you with me? Let's move towards one more good question. This is a little bit long question. Yes. Clarinet. So the following scenario relate to question 193 to 197. 193 to 197. It is the 1st July 20x5. Clarinet company Clarinet is a computer hardware specialist and has been trading for over 5 years. The company is funded. Can you read this question and try to understand what's going to happen in this question, because we have practiced 4 or 5 good questions. So can you try what is this? Is there any issue? Is there any adjusting, non-adjusting event? Try to read and try to understand, then we will discuss together. I'm giving you 5 minutes just to understand this question. So it is 1st July 2025. Clarinet company. Clarinet is a computer hardware specialist and has been trading for over 5 years. The company is funded partially through overdraft and loans and also by several large shareholders. The year end is 30th April 20x5. Year end is 30th April 20x5. And currently you are on 1st July 20x5. Clarinet has experienced significant growth in previous years. Okay, company is expanding. However, in the current year, a new compacted drums design company drums has entered the market and through compactive pricing has gained considerable market share from Clarinet, including one of its largest customer. So there is issue going some indicators because your market is captured by the compactor. Even they have attracted your largest customer. This means business is facing issues. They will not be meeting that much sale that they were meeting before. Okay. Clarinet is looking to develop new products to differentiate itself from the rest of the competitors. It has approached its shareholder to finance that development. However, they declined to invest further in Clarinet, mean shareholders say no money. Why? Might be companies not meeting the financial targets. That's why they refuse to invest further money. And if company do not have a finance, ultimately they will not be able to develop new products. If they are not developing new, they will not be attracting new customers. Issue. Clarinet's loan is long term and it has met all repayment on time. I mean, previously they were paying loan on time. The overdraft has increased significantly over the year. In companies having a negative cash balance, mean they are surviving on overdraft. And the director have informed you that the overdraft facility is due for renewal next month. And they believe it will be renewed, but overdraft facility is not that much amount that you can use for capital expenditure like for new developments. That will help to manage routine expenses, short-term cash flow. So company is struggling. The directors have produced a cash flow forecast which shows a significantly strengthening position over the coming 12 months. In their cash flow forecast showing positive cash flow over the 12 months. They are confident with the new products being developed and in light of their trading history of significant growth, believe it is unnecessary to make any disclosure in the financial statements regarding going concern. Though they are facing short-term cash flow, but they say no need for going concern or cash flow disclosure because our history is very good and we are confident we can generate more sale through new products. But for new products, you need to make investment and for that you don't have money. This mean might be this forecast that they have prepared that is based on the assumption like they will receive more sale through new product, but the new product you don't have money to launch, you don't have money to develop. And there are issues, but they don't want to disclose anything regarding going concern, regarding cash flow issue in the financial statement. Okay. At the year end, Clarinet received a notification from one of its customers that the hardware installed by Clarinet for the customer's online ordering system has not been operating correctly. Customer complaints company is receiving. As a result, the customer has lost significant revenue and has informed Clarinet that they intend to take legal action against them for loss of earning. Customer is saying, I will recover my loss from you because the system that you provided that I used for my online ordering system, that system was not operating effectively. Due to that, he suffered loss and he want to recover that loss from the claimant. And there will be chances of penalty for VM. Clarinet has investigated that the problem post year end and discovered that other work in progress in similarly affected and inventory should be written down by 375,000, and Clarinet investigated the issue. Yes, the issue was with the Clarinet. That's why the other inventory of similar nature of 375,000 they are going to write down. Write down means they will record loss, and this loss will result into more financial difficulties. The finance director believed that as this misstatement was identified after the year end, it can be amended in the 20x6 financial statement. No, if the inventory was recorded in balance sheet and that inventory is a faulty, so ultimately this should be adjusted in current year financial statement, not in next year financial statement. Draft financial statements for the year ended 30th April 2024 show profit 2.5 million, and if you check materiality of 0.375 against 2.5 million multiplied by hundreds, whether that is material or not. Please check materiality. This is showing 15% of profit and hence material. And if company do not adjust in current year inventory, ultimately there will be material misstatement. Are you with me? Okay, so this is the issue. Companies are facing cash flow issue because competitor have attracted your largest customer. You want to launch a new product, but you don't have money. Shareholder have said no more money, get lost. Company is mainly living on overdraft, negative cash balance, though they have a prepared positive cash flow, but that is not based on realistic assumptions. They don't want to disclose anything regarding going concern. And now companies are receiving a claim from the customer as well, and they need to write down inventory as well. So mainly company is having a difficult time. 193, try please. So which of the following correctly summarizes whether the uncorrected misstatement of inventory is a material and its impact on the 20x financial statements. So whether that amount is material, yes, that is material because 15% of profit. This means either C or D option. Is that adjustment in 20x 5 required? Yes, because this is post balance sheet adjusting event. The inventory is written in the balance sheet, that is a faulty. So option C. Are you with me? Try 194, please. Okay, which of the following factors are indicators that may cast a doubt on Clarinet ability to continue as a going concern? Going concern indicators we need to identify. The entry of new competitors reducing Clarinet's market share. Yes, this is indicator of going concern because they have attracted your largest customer. The significant increase in overdraft. Yes, you are surviving on overdraft. Bank's money. You don't have your own money. So this is indicator of going concern. The company has a long-term loan. Company has a long-term loan. No, this is not indicator. This is survival. Sir. And the reluctance of the shareholder to provide further investment. Yes, if they do not provide further investment in case of need, so ultimately company will not be able to survive. Might be they want to withdraw their investment. They want to sell the shares even rather than investing more money because they are aware about the company situation. Might be company is not paying them dividend. Might be company is not meeting the target that they are expecting. So option 1, 2, and 4. Option B is that. Try this 195, please. So as part of your assessment of going concern, you have reviewed the cash flow forecast. And this is based on the assumption of significant increase in revenue because company prepared based on the assumption like they will receive revenue with by launching a new product. But to launch a new product, ultimately they need a fund that they ask shareholder, they haven't provided. So which of the following procedure would provide the most reliable evidence regarding the validity of this assumption, like company will be able to receive high revenue in future? So what is reliable evidence? Email correspondence between the sale director and potential new customer, not email correspondence because email could be prepared by company management, could be fraudulent. So that is not reliable evidence. A review of board minutes showing details of new customers. One board minutes might be they will provide you fake board minutes if you because this is prepared by company management. And if you ask them, might be they will not provide the genuine board minutes. They will prepare fake board minutes where they have discussed positive things. A review of post year end sales and the order book. Yes, after year end, if we can see if company is receiving a bigger order from the customer, company is able to sell goods, company is able to generate enough cash through sales. Yes, company will be able to recover. The discussion with management regarding their plans for obtaining new business. Obviously, they will say we're gonna get new business because they have prepared the cash flow based on that assumption. So the most authenticate, reliable evidence is what? Post year-end sales and order book, whether company is receiving bigger order from the customer, company is generating enough sale or not. Are you with me? 196, please. 96. So you have concluded that circumstances exist which cause significant doubt on Clarinet ability to continue as a going concern. Mean there is going concern issue that you have concluded being auditor. This means company need to prepare financial statements on breakup basis, or if there is cash flow issue that need to be disclosed. Which of the following must you include in your communication with those charged with governors in accordance with ISA 570 going concern? Mean what you will ask company management to do. Whether the circumstances you have identified constitute a material uncertainty. Yes. And there is cash flow issue still there, if not going concern. Whether the use of going concern basis of accounting is appropriate in the preparation and presentation of financial statements. Yes, because you need to prepare financial statements according to breakup basis. The adequacy of the related disclosure, obviously, if not a breakup basis, there must be disclosure required. The period of time your assessment has covered is less than 12 months from the date of the financial statement, not less than. At least 12 months. Is that? This is wrong. So which one is correct? 1, 2, 3 option A. Is that? Try this last one. So the auditor have been informed that Clarinet's banker will not make a decision on the overdraft facility until after the audit report is completed. And if overdraft facility will not be renewed, company will be facing serious short-term cash flow issue. The directors have now agreed to include some going concern disclosure. And you believe these disclosures are adequate. Going concern disclosure means cash flow disclosure. And you believe this disclosure is adequate, mean appropriate, mean there is cash flow issue. This means if we have disclosed cash flow issue and auditors believe that is okay, this means opinion should be unqualified, but material uncertainty relating to going some paragraph we need to include to highlight that disclosure. Which of the following correctly summarizes the impact on auditors report of Clarinet if the auditors believe the company is a going concern, mean company will continue its business, but that this is subject to material uncertainty. Material uncertainty means there is a cash flow issue that is disclosed. So opinion should be modified, no. Unmodified, unqualified. Unmodified, yes. Material uncertainty relating to going some paragraph must be included, yes. To highlight cash flow issue, this paragraph will be used. Unmodified key audit matter, no. Modified, no. So which one is okay? Option B is okay. And only in this situation, this paragraph will be included in the audit report when there is cash flow issue disclosure in the financial statement, and that is correctly disclosed. This means financial statements give and fair and are prepared according to accounting standard, unmodified, unqualified opinion. Unmodified, unqualified opinion. But material uncertainty relating to going concern paragraph will be included to highlight that disclosure. Are you with me? And that's enough for today. We are having class tomorrow as well. 3 to 6. That will be our last class. We will discuss some more practice questions. And that will be last class. And after that, in coming week, we'll be having a mock exam, final mock exam. So see you tomorrow.